What if you could buy Apple or Google shares on a blockchain anytime, anywhere, without a traditional broker gatekeeping when the market opens or closes? Today, we dive into tokenized stocks, how they let you own pieces of major companies like Apple and Google on chain, what is working, what is risky, and where regulation is headed. Tokenized stocks are digital tokens tied to real world company shares, or sometimes synthetic versions that mimic price moves. For example, Apple X stock, ticker AAPLX, is backed one for one by real Apple shares stored by a regulated custodian. Each token is meant to reflect the real share price. Synthetic versions use oracles and contracts rather than real shares. They can be faster to launch, but often carry more counterparty risk. You can buy tokenized stocks such as Apple or Google via crypto exchanges or platforms supporting tokenization. Some providers include Xstocks, Backed Finance, and Denari. You need to check which blockchains they operate on. Ethereum, Arbitrum, or Solana are common. Always use the official contract address to avoid scam tokens. You can use centralized exchanges with tokenized stock desks or decentralized exchanges and wallets once the token is listed. Regulation has been murky, but it is shifting. The U.S. Senate recently updated its crypto market structure bill to explicitly treat tokenized stocks as securities under existing laws. That means tokenized versions of stocks must follow rules similar to traditional equities, including oversight by the SEC. Major exchanges are also making moves. Nasdaq has asked the SEC for permission to trade tokenized securities by 2026. Kraken is expanding X stocks to European users. Coinbase is seeking approval to offer tokenized equities in the United States. SEC Chair Paul Atkins appears more open to clearer rules rather than enforcement after the fact. There is talk of distinguishing tokenization as innovation as long as securities laws are respected. The advantages are clear. You can trade nearly 24 hours a day. Fractional ownership lets you buy small pieces instead of a full expensive share. Global access allows investors outside the U.S. to gain exposure in ways not previously possible. But there are risks. Liquidity is low, so large trades can move the price or require wide spreads. Most tokenized stocks do not grant voting or shareholder rights, even if they mimic the share price. That means no say in company decisions. Many versions do not guarantee redemption for the real share. Regulatory risk remains since future laws could change how these are treated or even if they are allowed. And there is counterparty risk since issuers and custodians must maintain backing one-to-one with proper audits. For investors, tokenized Apple or Google might be a new way to gain exposure. Flexibility, fractional access, and trading outside market hours are real advantages. But treat them as early-stage assets. Do not assume they behave exactly like owning the real stock. Be cautious about provider, platform, rights, and regulation in your country. If regulations continue moving toward clarity, tokenized stocks could become more stable, integrated, and trusted.